and that is how one should develop the value chain and understand about the what is the competition which is there into these products and what kind of a capacities the company is planning, because they don't directly disclose in the con calls or in their investor presentations. In this video, we'll be discussing about India pesticides. So today Aditya is with us, and Aditya looks for the chemical and agrochemical sectors at Value Educator. So welcome Aditya to YouTube channel.
Thank you, sir.
So let's start with the business model of India pesticides, and again we'll be discussing comparative discussion with other agrochemical players also, how India pesticides basically differentiated themselves till today, what are their margins, how they expanded their business over the period of time, and which are the different products India Pesticides is manufacturing, how they able to command such a premium margins. We'll discuss about that. So Aditya, let's first start with the business understanding of the India Pesticide, how basically this business got started, and what are the different segments they operate into.
Okay, so first of all, to give a brief background of India Pesticides, they first started their operations in 1984 with the manufacturing of agrochemical technicals and formulations. So they also manufacture some active pharmaceutical ingredients which are used for the pharmaceutical industry. Starting with to give a brief about the business, the company operates into two main business verticals, which are pesticides and bulk drugs. So under pesticides, they have agrochemical technicals, the intermediates which act as the backward integration for technicals, and agro formulations. Bulk drugs, they basically manufacture APIs which go into the dermatological applications. Let's have a look at the agrochemical value chain first. So as you can see, starting from the key starting materials, you get the intermediate, then you go for the technicals, and then finally formulations. So as I mentioned earlier, the company is into the intermediates, technicals, and formulations. This is their presence in the agrochemical value chain. To compare it with Punjab Chemicals is present only in the intermediates and technicals.
Right.
Also SRF, which we have covered in the previous video, it is also present into the intermediates and technicals.
So in this case of India pesticide, most of the revenues they get from the agroactives or the basically technicals, and that's how they able to command the better valuations also, because the products are little bit niche or differentiated.
Yeah.
Plus another point is can be like they have the backward integrated value chain, which we'll discuss as we'll go along in this video.
So now talking about agrochemicals, so they have some key technicals which are shown in the table. So basically prosulfocarb is their existing key herbicide, and prettilachlor is the newly launched herbicide. They have launched two new insecticides which were not part of their product portfolio earlier, which are diphentheuron and thimethoxam. And in their fungicides portfolio, they have Captan and Folpet, and cymoxanil and Xyram, which are their key fungicides. So these are their key technicals. And looking into formulations, you can see the branded formulations which the company mainly sells in the domestic market. These formulations come in the herbicides, fungicides, and insecticides category, and you can see the brand names for these formulations as mentioned in the table. Mentioned earlier, the company gets the majority of its revenues from the technicals, which can be seen from this chart, where the contribution from the technicals has increased from 60% in 2018 to 71% in 2022. Contribution has increased due to the continuous capacity expansions which it has done in the technical side, and also when we'll cover forward, they have also increased their contribution from the export business.
Right. One point, Aditya, here is like the companies which are majorly focusing on the technicals or agroactives, they generally command a better margin, because the technology which is required for the production is much basically complex compared to manufacturing any formulation. So formulation is nothing but mixing of various basically intermediates or agroactives in a different proportion, while when you manufacture the intermediates or agroactives, where the technology can be a key criteria or key differentiator, which we can see from the financials of the basically Punjab Chemicals, which we can see from the financials of the India Pesticides.
Yes, so we'll see that going forward. Now that we have seen the business of the company, let us understand the brains behind the company. So the company is headed by chairman and founder Mr. Anand Swarup Agarwal and CEO Mr. Dheeraj Kumar Jain. So Mr. Anand Swarup Agarwal holds a bachelor's degree in law and he has 36 years of experience in agrochemicals manufacturing. Mr. Dheeraj Kumar Zain has a bachelor's and master's degree in chemical engineering from Osmania University, Hyderabad. He is associated with the company since 1st December 1995, and he has over 25 years of experience with the company. He handles various areas like product development, international business development, and project engineering. Talking about the manufacturing facilities, the company right now has two manufacturing facilities at Lucknow and Sandila, which are combined are spread over a land area of 25 acres.
Right.
The company makes agrochemical technicals and formulations at Lucknow, and in Sandila, along with the technicals and formulations, it also makes the intermediates, which act as the backward integration for the technicals.
Right.
So the formulations overall, which are made by the company, some of these formulations are forward integration of the technical products, and for some of these formulations, they source the technical externally. So the capacity utilization as of Q3 FY23 for the technicals and formulations was 72% and 40% respectively.
Right.
So the capacity utilization for the formulation plants was low in this quarter due to the channel inventory in the local market, as mentioned by the company in their con call.
And one important point for the technicals is like in case of technicals, you cannot reach to 100% or even 90% of the capacity utilization. Generally, the capacity utilization on the maximum side can be about 70 to 75% because this business is also seasonal business. So that's why in some of the quarter they can probably run at the 100% capacity utilization. In some of the quarters they might run at the 50% capacity utilization. That's why in on an average the capacity utilization for any agrochemical technical or even a formulation manufacturer may not be 90 or 100%, so that one should understand.
These are the two facilities which are there right now at Lucknow and Sandila. So the company has incorporated a new subsidiary, Shalvi Specialties Limited, which has acquired a 25-acre land in Hamirpur, and they will oversee the new greenfield capacity expansion which will be coming up at Hamirpur, for which the company has recently got the environmental clearance from the regulatory authorities. So the details of these manufacturing facilities along with their production capacities are summarized as shown in the table. You can see that in Sandila was recently established in 2015, while Lucknow is an older facility. So for Hamirpur, we'll cover the detailed plan how they are planning their capacity expansion in Hamirpur. And for Sandila, right now you can see that they have the technicals and intermediates at 21,700 tons, which will go to 25,400 tons once they complete their entire project at Sandila. And for Hamirpur, they will be coming up with 36,000 tons of technicals and intermediates, 29,200 tons of formulations, which we'll cover in depth later.
Right. So currently they have, I think, like the capex which are going on at Sandila as well as the new capex for which got the environmental clearance port while for the Hamirpur facility they recently got the EC approval for which also they already started the capex, and the outcome or the revenues reflection we can see from the FY24 end or probably from the FY25.
So the talking about the operations of the operations of the company are mainly divided into two, domestic business and international business.
Right.
So first we'll start with the domestic business. So the domestic business of the company is purely based on branded formulations, while the company makes some bulk formulations which are exported to customers in various countries. The bulk formulations ka export contributes 2 to 3% to the business of the company.
Okay.
So the formulation business for any agrochemical player, it is basically business based on brand as well as your distribution network.
Right.
So as a part of the distribution network of the company, they have 20 sales depots, 20 company branches, 18 warehouses, and 4,712 dealers as part of the distribution network. They are present in states such as Punjab, Haryana, Rajasthan, Gujarat, Madhya Pradesh, and others. The plan of the company here is to take their presence pan India for their formulation business. Branded formulations which are made by the company are supplied to players in the domestic market like UPL and Sharda Cropchem, which are there into the formulations.
Right, right. Only issue with the domestic market is like it is highly dependent on the monsoon, and plus they have the geographical risk, which actually reduces when you go for the export or the basically in different countries like Australia or US or European countries. So that's why generally the export business of the most of the agrochemical companies is more stable compared to the domestic part of the business.
Okay, so now we'll come to the international business. So the international business is purely an export business where the company exports its technical products on a contract basis to customers in over 40 countries. They are based in regulated markets such as US, Australia, Europe, South America, and Asia. The company supplies technicals to global MNC players under long term contracts which span usually 5 to 7 years, and the raw material prices are checked every quarter or half year. The company has a clause in its contracts where it can renegotiate any change in the raw material prices every quarter or half year with their customers. The company selects its molecules which it wants to contract manufacture for the customers after getting the agreement from the customers.
Right.
So the key criteria before they enter any contract is the company allocates 50% of their production capacity for a single customer, and then the remaining capacity is allocated for other customers. This criteria is followed by the company in all of their contracts, and they have been following it for a very long time. The technicals made by the company are supplied to clients like Conquest, Syngenta, Stratas, and Eskenza in the foreign markets. So now that we have seen the domestic and international business of the company, let us now see the revenue mix between the domestic and exports business. So as you can see from the chart, you can see that the contribution from the export business has consistently risen from 39% in 2017 to 53.3% in the 9-month FY23 period. Again, from this chart, we can see the top 4 customers of the company. They have contributed more than 40% to the business of the company consistently, with the contribution which has come down to 39% in FY22. So this was all about the operations of the company. Now we'll see how they have done their capacity expansions over time. So before 2015, as you have seen in the table for manufacturing facilities, the company had manufacturing facility only in Lucknow with a technical capacity of 2100 tons and a formulation capacity of 3000 tons. In December 2015, the company commissioned their new manufacturing unit at Sandila with a starting capacity of 1500 tons for technicals and 3000 tons for formulations. So since then they have done capacity expansions only in Sandila and majorly for technicals.
Right.
So the chart in the image shows how they have increased their capacity over time with the respective capex amounts. During the period FY20, they did a capex for 31 crores, was to increase the formulation capacity from 3000 to 3500 tons, which was the only expansion for formulations done during the period FY19 to FY22.
So from here we can at least understand the major focus of the company is majorly on the technicals and whatever raw materials which are required to manufacture those agroactives or technicals, which can be basic chemicals or intermediates, that company is focusing on. And they have never focused much on the formulations as a business vertical. After that, let's discuss about what is the product differentiation criteria for the company and how they able to make such a high margins. Like if you check the EBITDA margins of the company, which is about 30%. So having a 30% EBITDA margins is very, very high in any agro-based basically company or agrochemical company. So Aditya, let's start with the about the product differentiation strategy.
In this differentiation strategy, we'll cover 3 components. Basically, their product strategy, how they have launched their products, and the competition in these existing and new products.
Right.
So starting with their product strategy, their strategy is based on 3 elements. The first element is they enter into those products which have gross margins 45% and above. Second part is they initially soft launch the product and then they go full scale with complete backward integration for their products. The company makes the technical products right from the basic stage, starting with basic chemicals like carbon disulfide and chlorine. So carbon disulfide and chlorine are the basic raw materials for their Captain Technical. The other agrochemical players basically start manufacturing the technicals from the N-1 stage, which is the intermediate stage, and the intermediate is mostly imported.
Right. Right.
As the company, also the third major part of the strategy is the majority of the raw materials are sourced locally with minimum dependence on imports, which helps them to withstand the volatility in raw material prices and ensures continuous supply for their operations. So now we'll see some examples of how this strategy has played out for the company. So as an example of the strategy, The company soft launched Pretilachlor, which is a herbicide
Right.
and a new product for the company in Q4 FY22. Then in Q1 FY23, they commissioned the intermediate for Pretilachlor with a capacity of 2000 tons, and they plan to make Pretilachlor which from the starting material, which is aniline.
Yeah.
So aniline will be the basic raw material for the company, from which they will make diethyl aniline, and in other 2 to 3 steps they will make Pretilachlor. As you can see from this value chain, so as you can see from aniline, diethyl aniline, and in 3 to 5 steps they'll get Pretilachlor. So as I had mentioned earlier, the company makes their technicals from the very basic chemicals, as you can see from this Pretilachlor
So they
example.
basically have a good command on their complete value chain, and that's actually a reason that this company is able to get these type of margins, which is more than 27-28% up to 30% on the EBITDA level, which is a fantastic margins. And at the same time they able to keep the asset turns of 2 to 2.5. So if you can calculate the ROC, so it is more than 40 to 50%. But only thing is like the company able to maintain these margins or not, for which we'll discuss about like which are the competitors which are entering into the similar products and what the future looks like.
Now we have seen how the company works on their product strategy for the second point. Now let us see an example where they source majority of their raw materials locally. So as you can see from this chart, for the years 19 to 2021, more than 60% of their raw materials have been sourced locally, with the remaining coming from imports. So the major raw materials of the company are chlorine, carbon disulfide, tetrahydrophthalic anhydride, cyanoacetylethylurea, ammonium thiocyanate, diene-propylamine, phthalimide, and some other raw materials. So out of these raw materials, tetrahydrophthalic anhydride, ammonium thiocyanate, diene-propylamine, and cyanoacetylethylurea are imported from regions like China and Taiwan, and the other raw materials are sourced locally. So in FY21, they had a China dependency of 30.29%, which they have been able to successfully reduce to 20% as of now, due to their focus on backward integration for their products.
Right.
So now that we have seen the strategy of the company, let's see how the company has launched products in the period of FY22 to FY23.
Right.
So the company first launched its IPO on 5th July 2021 with at a offer price of 300 rupees per share, and the proceeds from IPO were rupees 800 crores, out of which 100 crores was a fresh issue and the remaining was an offer for sale by the promoters. The company, when they launched their IPO, they had a plan to launch 8 products over the period of FY22 to FY23. Out of these 8 products, 2 were intermediates and 6 were technical grade products. The company launched 5 products in FY22 and has already launched 2 products in FY23, taking the total count to 7.
Okay.
And the remaining product will be launched in Q4 FY23.
Right.
The details of some of these products are as mentioned in the table. So as you can see from this table, some of the products which have been launched are in FY22 they have launched Pretilachlor, diphenthioron, and thiamethoxam, where you can see the revenue potential as listed in the table. In Q1 FY23 they launched backward integration for Pretilachlor, which is again their focus on the backward integration. And in Q3 FY23 they recently launched metribuzin, which is an export product, the revenue potential for which you can see in the table, and it will be mostly catering to the export market.
Right, and for the Pretilachlor intermediate, mostly it used to get imported, right? So
Yes.
they basically are looking for the import substitution also
Yes.
for basically their own consumption.
Yes.
As well. They will be like selling that product in Indian market or probably exporting wherever
Yes,
there
yes.
is a demand.
All the intermediates which they'll be making, they'll be using it for captive consumption as well as they'll be selling it in the market as
Right.
well.
And another thing for this Pretilachlor intermediate, there is no other Indian manufacturer. So India Pesticides also look for those products where there is a very limited competition which is available at least domestically.
The product which is going to come online in Q4 FY23 is an intermediate with a revenue potential of 60 to 70 crores at peak capacity. These are the products which have been launched over the time by the company, total 7 products, and the 8th is going to come. Now that we have seen the products which have been launched by the company and the key technicals of the company, let us now understand the competition in the existing products of the company as well as the newly launched products of the company.
Right. Because understanding a competition is really important, because the margins which we are seeing right now may not able to sustain in future. So to have a better understanding, we should understand what competitors are doing, what kind of a products they are entering into, and that is how we will able to understand can these margins are sustainable or there can be a decrease in the margins, which currently I think are very superior margins which are posted by the India Pesticides.
So first we'll see the existing products which are Captain and Folpet, which are their fungicide technicals.
Right, and these are also their major products, right? Out of
Yes.
top three products, these are the top two products.
So for Captain, the company has a capacity of 2400 tons per annum, and for that technical grade, recently Herenba Industries and Best Crop Science LLP, they have applied for a fresh capacity of Captain as per the recent environmental clearance reports, and the capacities are as shown in the table. Adama makes the fungicide formulation, which is known by the brand name Shamir, which is a mixture of 6.7% tebuconazole and 26.9% Captain by weight. If you go through the con calls of the company, they have constantly mentioned that Adama is their competition.
Right.
So Adama is basically into the formulations of Captain.
Right, and Aditya, this tebuconazole is basically a triazole chemistry, right?
Yes.
Which I think
Yes.
Aztec Life Sciences
Yes.
is majorly into.
Yes. So for Folpet, as you can see in the table, the company is the only manufacturer of the technical grade product in India, and there is no competition in India or overseas. So this is for the existing products. Now let us see about the new products which have been launched by the company. So for diphentheuron, the capacity of the company is 120 tons per annum, which is quite small as compared to the other players as seen from the table. And also Insecticides India, Herenba Industries and Dharmaj Crop Guard, they have applied for a fresh capacity as per their recent environmental clearance report. Thus, the company has some stiff competition for the newly launched diphentheuron insecticide. Adama makes the insecticide formulation, which is known by the brand name Takaf, which is a mixture of 47% diphentheuron and 9.4% bifenthrin, which is a pyrethroid insecticide product.
One of the very important point, Aditya, is like understanding and reading about the EC reports, because these all information is very nicely given into the EC report. What are the intermediates? What are the bulk drug? What are the bulk chemicals which are needed for that particular technical or the agroactive or the formulation? And that is how one should develop the value chain and understand about the what is the competition which is there into these products and what kind of a capacities the company is planning, because they don't directly disclose in the con calls or in their investor presentations or probably in annual reports also. So understanding and reading about the EC document is very important.
So yes, since I've been tracking the chemical industry for almost 4 to 5 months, I can say this point that if you don't read the EC of the particular chemical company, you won't get the complete understanding of the chemical company. So EC reading is a must if you are tracking the chemical industry. So moving on to thiamethoxam, which is another insecticide product. The capacity of the company is 3,650 tons per annum, and here the competition is Best Crop Science, Insecticides India, and Dharmaj Crop Guard, with the major competition being Insecticides India, whose capacity will become almost 10 times of the company's current product capacity once their additional capacity comes online, as seen in the table. So once their additional capacity comes online, their capacity will increase to 36,000 tons per annum. So this is almost 10 times of the company's current product capacity.
Right.
Coming to Pretilachlor, the company has a capacity of 3,650 tons per annum, and here the competition is again Best Crop Science, Insecticides India, and Dharmaj Crop Guard, where all of them have a capacity which is almost at a comparable level to the company as seen in the table.
But Aditya, like this is like this information what we have collected, that is definitely a very good information. But we also have to see like which all players actually have the backward integration, because that will be a differentiating point. Not only like the which are the additional capacities which are coming in India or in different countries for the technicals or agroactives, but if you don't have that backward integration and something like COVID or some, like when the supply chain gets disrupted, like what is happening due to the war situation, then actually your margins might get hit or your production might get hit, which is the differentiating factor by the India pesticides.
Right now, if you have gone through the con calls of agrochemical companies for the Q2 and the Q3, all of them have mentioned this point of backward integration,
Right.
where they are going for backward integration for their products to withstand the raw material price fluctuations and also to reduce their dependency on China.
Right.
So this has been the trend which is going on in the agrochemical industry as of now. So now moving on to the next product, metribuzin. As I mentioned earlier, the company has a capacity of 300 tons per annum, and here it faces tough competition from Rallis India, Dhanuka Agritech, and Best Crop Science, who have capacities which are significantly higher than that of the company. The company will face potential competition from Insecticides India and Dharmaj Crop Guard, who have applied for fresh capacities of the product as per their recent environmental clearance report as shown in the table. So, out of these competitors, the major competitor for India Pesticides will be Rallis India for metribuzin. As for metribuzin, they have a capacity of 4,000 metric ton per annum, and they have a 15 to 20% global market share in this product, and it is also their key product.
Right. Aditya, can you just briefly explain about like how one should study about the agrochemical as a industry or the different companies, how you can differentiate between two companies? Let's take an example of India Pesticides and another video which we have created on say Punjab Chemicals. So how you compare the business models of these two companies, what are the differences, and then how to conclude about like the superiority or which company have a better business model if you can tell about it.
If you have to compare about two agrochemical companies, so as I said, EC report is a must read. So by studying the EC report, you will understand the technicals which are made by the company. You can compare the capacities of the key technicals,
Right.
and also how the company is backward integrated for the technicals. So for, if I talk about Punjab Chemicals, their key products are metamyton and metconazole. So they basically import the hydrazine hydrate which is required for the production of metamyton,
Right.
from Europe and Japan under the long term supply contracts, and from starting from hydrazine hydrate, which is the basic chemical, they make their metamyton technical. This India Pesticides, their key products are Captain and Folpet. Talk about Captain, they start from chlorine and carbon disulfide, which are the basic chemicals, and starting from those basic chemicals in 5 to 6 steps, they get Captain technical.
So basically, we need to understand the products very correctly. Then only
Yes.
we can comment about the
Yes.
particular companies. And then apart from that, like if you check the Punjab Chemical case, then they are mostly into CRAMS, be it innovative based CRAMS or be it generic based CRAMS. So that is also a little bit differentiating factor between these two companies. I
Yes.
think India Pesticides also in then one of the con calls have mentioned that in future they are also going for the contract manufacturing type of business model. Currently
Yes.
probably they are not focusing much on that side or that segment.
Yes, they have mentioned in their Q3 FY23 con call that they will be open to CRAMS opportunities going forward.
Right.
This is one part where I talked about how you compare the products and how the company is backward integrated for those products. So backward integration is one aspect. Second is you have to check about the ban on the products or the possibility of the ban for the product by seeing the toxicity levels. So the first part is you compare the backward integration of the company. The second part is then you see the, for the particular product, how toxic it is, and you can check this toxicity by the LD50 parameter, which tells the toxicity. So the lower the value of this parameter, the more toxic the chemical is.
And I think very important is where that particular product got banned in different countries, because what happens if a particular product gets banned into say Europe, generally it is followed by other countries also, so that can be a potential risk which
Yes.
the product can have in the future.
Yes.
So having a product understanding also is very important while we are studying into the agrochemicals as a industry or like a different stocks into.
So as I said, the product understanding, the toxic nature of the product, and the possibility of ban.
Right.
So these are three important parameters while you study any agrochemical company. And then also you see whether it's a CRAMS business or not, then how they have managed their working capital, because
Right.
in agrochemicals, working capital is usually stretched for the
Right.
companies.
Because they have to carry a lot of inventories because it's a seasonal business. So before the season starts, they have to maintain those inventories, because sometimes that season can be very short window kind of a season also, like for a 20 days or for a month. For that they have to stock the inventories, and That's why it is sometimes a very highly working capital intensive kind of a business. But that is in general with the agrochemical as an industry. So if you check different players like India Pesticides or Punjab Chemicals or maybe Aztec Life Sciences, so more or less every player have this challenge of higher inventory management or higher working capital basically management.
So now that we have seen the product strategy and uh, launch and the competition, now we'll see how the company has performed over time. So as seen from this chart, you can see this is the chart between the revenues, gross margins and EBITDA margins. As seen from the chart, the revenues of the company have increased consistently from 248 crores in 2018 to 697 crores in 9 months FY23 period. Also, there has been a similar rise in gross margins from 49.81% in 2018 to 56.92% in 2022. So, this continuous rise in gross margins is due to the focus of the company to enter into high gross margin products, as we have mentioned earlier, and to also make the products from the very basic chemicals with complete backward integration for the given products. The reasons for drop in gross margin for the 9-month FY23 period was due to the carryover of the high cost inventory and
Right.
the increase in operating and fuel cost.
Right.
The company expects its gross margins it to stabilize at 50% in the next 2 to 3 quarters. So to give a information about gross margins, it was 48.5% in Q1 FY23, 43% in Q2, and for this Q3 FY23 they have a gross margins of almost 46%.
So there has been a little bit recovery compared to quarter two 2023 compared to like recently in this quarter they have posted a little bit better gross margins, and I think this is a industry wide situation. So every agrochemical company has posted the bad results or there has been some dip in their margins because of either high cost inventory or basically due to the fuel cost also. So
Yes.
there is a some shortage of coal.
Hmm.
The companies are not able to procure the coal from the government. That's why
Yes.
they are importing the imported coal. So that's why basically their margins got impacted. But I think this can be a short-term issue. In next 2 to 3 quarters, the margin should able to stabilize to their historical levels.
So one important point which the company has mentioned about their gross margins is that the gross margins won't deteriorate from the 43% level. Means in Q2 they had 43% gross margins. What they are trying to say is they won't go below the 43% gross margin level. So now we'll compare see the trend in the EBITDA. So as seen from the chart, the EBITDA margins have also risen consistently from 27% in 2018 to 30% in 2022, and there has been again a drop in EBITDA margins for the 9-month FY23 period. The reasons are the logistic problems faced by the company, the increase in the price of some of the raw materials in India and which they import from outside. So to avoid production loss, what the company did was they bought more raw materials than they usually do at the higher price. They are now stuck with the high cost inventory,
Right.
for which they have not been able to pass on the prices fully to their end customer.
So I think they have used some of that high cost inventory in quarter three, and management has guided that the part will be used in quarter four, and from quarter one onwards, actually their margins should go back to their historical level. But despite that, the management has giving a guidance that they won't able to reach to EBITDA margins of 30%, which they have historically clocked. Initially, they have reduced that target of 30% to probably 26 to 29%.
Yes.
And after that, now they are saying the EBITDA margins can be 25 to 26%,
Yes.
because of the various challenges, or probably the competition is also entering into their products. Another challenge is the fuel cost also. So here we actually have to understand or read between the lines what management is trying to say and what is the actually impact the business has gone through. But despite having like a 25% EBITDA margins, it is a fantastic margins in any kind of a, in particularly chemical industry, because if you check even PI industries margins, so they are having a basically EBITDA margins of about 17 to 20%. And in case of India Pesticides, they have the asset turn of about 2 times or 2 to 2.5 times. So due to that, if you calculate the ROC, it is like 30, 40 or 50% also.
Yes.
But so as India Pesticide have these superior margins, it will also attract a lot of competition also. So we have to keep on monitoring that, like if they can maintain these margins, and that is how the market will finally give the valuations. We should not be in basically that thought process that the current margins are very good margin. That means like it is a very superior business. The business might be very good, but we have to see this as an investment candidate. And investing and understanding a business can be two different things. Good business may not be a very good investment, and moderate business may not be very bad investment. So we have to balance between the price or the premium versus the valuation which we are willing to pay for that particular business. So here I will be keep on monitoring this business as will go ahead in the future. And if they can even maintain 25 to probably 23-24% margin, it is an excellent business according to my understanding. Important is can they able to protect or sustain these margins.
So as we were discussing, they have not been able to pass on the prices fully of the high cost inventory which they have been carrying over till now. On the EBITDA margin side, for the fuel, they use green fuel, which is rice husk. So the rice husk prices have risen almost threefold from rupees 300 per quintal to rupees 900 per quintal. Come down 850 rupees per quintal, but still it is on the higher side. Excluding the herbicide category, the company has been able to pass most of the price increase to its end customers. And in herbicide, they have been partially able to pass on the raw material price increase. So to mention, just give a pointer about rice husk. Punjab Chemicals also uses rice husk as their fuel.
Right.
So if you check their recent Q3 result, it has not been such a good result as compared to the Q2 result. Again, one of the reason is this increase in the rice husk price. The inventory which I have been mentioning over and over. So right now they have inventory worth 225 crores as of Q3 FY23, and by FY23 the management has guided to reduce the inventory by 25 crores.
Again, I think they were mentioning about a similar point that like they started building the inventory because one of their product have a very good demand during quarter 1 or quarter 2, and that's why from quarter 3, quarter 4 onwards only the company started building their inventory. So this is the nature of the business, which is the seasonal.
Yes. Now that we have discussed the current affairs of the company, let us see the future plan for the company. For their Sandila expansion, they had planned a total capex of 140 crores, out of which they have spent 70 crores in FY22.
Right.
And they plan to spend 70 crores in FY23. So out of those 70 crores, 54 crores has been spent by the company in the 9-month FY23 period. And this capex of 140 crores is expected to have an asset turns of 2 to 2.5x.
Right.
The capacity expansion project at Sandila is on schedule. As part of this capacity expansion project, the company recently commissioned the new herbicide metribuzin with the capacity of 300 metric ton per annum, which will focus majorly on the export market. This herbicide has a starting price of rupees 3,500 per kg as mentioned by the management. The intermediate capacity, which is the part of this capacity expansion project, will come online in either March or April 2023. Okay. So the total capacity addition, including metribuzin and this intermediate, is 4,000 metric ton per annum, which will take the total capacity of technicals in the Sandila unit from 21,400 tons to 25,400 tons per annum. And the company has obtained the permission from the regulatory authorities to install total 30,000 metric ton per annum technical capacity at the Sandila unit. Plan of the company post the Sandila capacity expansion is completed is to launch 14 molecules, and out of these 14 molecules, for 5 products the company is backward integrated, and for the other products, one of the key raw materials which was first being sourced from China, the company plans to mitigate it by doing the backward integration and developing their own technology.
Right. And another thing what the management was saying in this quarter 3 con call is like after the current expansion at Sandila, more or less the land will be completely utilized, and at the max they can put some one of MPP plant, and after that all the future expansions will be done at the Hamirpur. So let's discuss about the Hamirpur capex, what kind of a capex the company has planned, and what revenue visibility we can have in next 3 to 4 5 years.
So before talking about the Hamirpur, when I was going through the con calls of the company, they have constantly mentioned that they don't use MPP plants due to the issue of contamination, which is again the part of their product strategy to not go for the MPP plants. So now,
plus they are like, I think herbicide and the insecticide sections are also separated. Yes. They were saying because there can be a contamination and that can cause the quality related issues.
Yes. So as mentioned, the space at Sandila will almost be completely filled. So the major capacity expansions going forward will be from Hamirpur. So now let us see the plan for Hamirpur. So for the Hamirpur project, the company has got the environmental clearance, and this Hamirpur project will be a greenfield capex for the company. The capex spent till date for this Hamirpur project is 7 to 10 crores, and they plan to spend another 7 to 10 crores in the remaining 2 months of the FY23. The company plans to spend rupees 100 crores each for the next 4 years for the Hamirpur site, with the first two units expected to come online by December 2023 or January 2024. Initially, the plan of the company will be to manufacture intermediates as they require less number of regulatory approvals as compared to the technical grade products. The plan of the company here is to establish 36,000 tons of technical and intermediates capacity and 29,200 tons of formulation capacity, with the focus being on new molecules, and the production expected to commence by Q4 FY24 with the full revenue potential to kick in by FY25. The asset turns, as mentioned by the management, will also be in the range of 2 to 2.5x. And by new molecules, I mean that whatever products they have been making at Sandila and Lucknow, those products won't be made at Hamirpur. Hamirpur will be for completely new products. So if you check their EC for Hamirpur project, which is under the name of Shalvi Specialties Chemicals, so you can see that they have applied for pyrethroid group insecticides and triazole fungicides, which they were not making earlier.
So Aditya, like one surprising thing here is like they probably got this EC somewhere in November or December of 2022.
Yes.
And the management is saying like the plant will be operationalized or commercial production at least for the intermediates might start from the December 23 or January 24. So it is difficult to believe that the greenfield plant can be set up in a 1 year. Definitely, this is not like the complete capex they are planning in a single year. It is only a part of a capex out of total 400 crores. They are planning 100 crores for the first year. But still, it is quite commendable that the management is planning or giving a guidance that in the first year they will able to run the greenfield capacity. So we have to see the execution also.
Yes.
The EC report, whatever they got, that is quite on a time. And along with that, certain other approvals also they got, and the construction I think has already started for the Hamirpur plant, and we'll see like how they able to execute and when the actual intermediates production starts at the Hamirpur facility.
As I had mentioned earlier, post their IPO, they had launched 7 products, out of which 6 were technicals and 1 is an intermediate. The remaining intermediate, which will come online in Q4 FY23, which is the part of this product plan, this intermediate is not made by any other company in India. So the company used to import this intermediate earlier, and now they will make this intermediate in-house with a plan of import substitution.
So Aditya, this intermediate is different from the Prettilachlor intermediate, right?
Yes.
So same was the story with the Prettilachlor that
Yes.
it was not manufactured by any company
Yes.
from the from India. So we can connect the dots like this is what the strategy of the company
Yes.
is.
Again, the company has backward integration for the 6 technicals which they have launched, and these products are expected to bring a revenue of 250 crores by FY24, with the 9-month FY23 contribution being at 12%. These products have a 1,000 crore market size in India. So the company is in discussions with the customers in the US, Australia and Japan for the new products, and it is simultaneously working on the registration of these new products.
So company seems to be quite energetic about their new products because currently they are hardly probably like every quarter it is 20 to 25 crores of the contribution from the new products which the management is guiding about 200 to 250
Yes.
crores over the period of time. So that is quite
So,
interesting.
as I had mentioned earlier, in FY22 they had launched 5 products, and those 5 products FY22 contributed 8 to 9% to the top line of the company.
Okay. So they keep on adding newer and newer products in their kitty, and but question is like the newer products may not have the similar margins compared to Folpet and the top 3 products where they have a
Yes.
superior margins.
They have superior margins, but as I said, their focus still remains on entering into the high margin molecules, which you can see from their gross margins.
Right. But we have to check the average margins, which will combine the older products, high margin products, and plus additional new products which might have a little bit lesser margins compared to their older products. So average margins might decrease from say 30% to 25-26%, which market might take as a negative because generally the re-rating is given to those stocks where the operating leverage or product mix change actually takes place. That's why the profitability is actually increase or grows a lot compared to the revenues. So this might not be the case with the India pesticides, but despite that, we have to keep on tracking what margins actually the company posts over the period of time.
Given all these capex plans and the new product launches, the company has given a guidance that they plan to reach 1,000 crores revenue by FY24, and
Right.
all the capex plans they plan to fund majorly by internal accruals.
Right.
The company has clocked a revenue of 716 crores in FY22, so there is a high probability of achieving their FY24 target.
Right. So one of the very interesting thing which I liked about this company, it is like a majorly debt-free company.
Yes.
Because generally in agrochemicals, like you need a very high amount of working capital for which most of the company takes the debt. Another thing is like they are also in the capex program so that they will need the long-term debt. But in this case of India pesticide, I think they have managed this situation very nicely. Definitely, they have done the IPO also recently, but despite that, I think this is a very good point of this company that they are planning their all working capital needs plus future expansions based on their internal accruals and not going for the any short or long-term debt. After this, let's now discuss about the what kind of a risk company have.
Major risks faced by the company are first and foremost dependence on their top three products. The top three products have contributed in the range of 40 to 45% to the overall business of the company. Though these products are not banned in major geographies like Europe, the US, and Latam, ban on agrochemicals is nothing new. And if a ban is imposed on these products, it would seriously affect the business of the company. The top four customers, as I mentioned earlier, they have also historically contributed more than 40% to the business of the company, with the contribution which has just come down to 39% for FY22. A downturn in the business of any of these customers could affect the business of the company. And finally, the business of the agrochemicals is a hazardous business with a high probability of fire and explosions. Any such incidents could lead to disruption in operations of the company, which has happened with Punjab Chemicals and
Even Deepak Nitrite and
yes,
then Anupam Rasayan and many other
yes,
companies.
and on recently on 24th February 2023, it happened with Sumitomo Chemicals India.
Right, right. So that is always a risk. That is also a risk majorly into fluorinated based companies also. If you check, like if there was a big blast which has happened into UPL also, and that's why that plant is probably not producing anything. So that is always a risk in any kind of a chemical company. So till now, I have not invested into India pesticides, and I will be tracking the situation of the company. Like basically, can they able to protect their margins over the period of time or not? But because generally for Q4, most of the chemical or specifically agrochemical companies have given a little bit negative guidance because of channel inventory and some other issues like the demand is getting slowed down in Europe and US. So I'll be monitoring this company for like couple of quarters and then only I will be like taking a call. Right now it is in my watch list, but I have not added yet in my portfolio because I am getting some better opportunities compared to India pesticides with the business valuations also and the quality of the business also. So at Value Indicator, we keep on finding out these different opportunities. We do the lot of scuttlebutt research. We also do the competitive analysis. Initially, I have posted the video on the Punjab Chemicals, then and after that in this video we have explained about the India pesticides. We'll be doing another video based on the Aztec Life Sciences, so you actually can understand like how different agrochemical companies have differentiated business models, what is like the common or comparable thing, what different chemistries they are into. So these activities we keep on doing at the Value Educator, and we try to do the very in-depth research so that like whenever the bad time comes we can have a solid conviction during that time, so that we can keep on holding those stocks, or provided that or we also can take advantage of the market corrections if the story remains good. So similarly we are also finding out the opportunities, the micro size companies where the disclosures are very poor, or these are the undiscovered or basically undervalued and unresearched opportunities where we actually go on ground and try to meet with the management, we visit the plants and understand about the business from their competitors, and then we build a position into these companies. Because There we get the comfort of the valuations because no one is actually understanding or doing any research on these companies, and that's why that whole space is open for the guys who are actually interested into the groundwork or the research. So this kind of a research is shared with our microcap club members. So you can check the details of the microcap club on my website, for which the link is given in the description, and there is a complete detailed video I have created on the microcap club. So you will get an understanding what it is. Basically a common platform where the different investors can come together and share their understanding on the different stocks, micro sized stocks or the small cap stocks, where the information is very limited, but we get this information based on our scuttlebutt. So till now you have not joined the microcap club, you can join the microcap club, for which link is given in the description. And currently we are offering the extra months for the different plans starting from 1 year, 2 year, 3 year and 5 year. So you can take the benefits out of it. And if you are liking these discussion sessions, today we have done with the Aditya, other day we have done with the Varun. So make sure that you like this video and show us your support, because we are also working very hard at the value educator to give you a better and better understanding of the different business models and coming up with the quality content. So let's meet at 11 o'clock next Saturday with some other different topic.